Hey everyone, welcome back to the channel. Today we are diving into a topic that's been on everyone's mind: how to grow your money without losing sleep over it. Imagine this: you are sitting at home sipping your favorite drink and your money is working hard for you in the background. Sounds dreamy, right? Well, it's not just a dream. I'm going to share with you 5 easy investment options that are secure, profitable in the long run, and super easy to understand even if you are not a stock market expert. Let's get started. Let's face it, investing can feel overwhelming. There is so much jargon out there: stocks, bonds, ETF, mutual funds. It's enough to make your head spin. But here is the thing: you don't need to be a Wall Street expert to grow your money. You just need to know a few simple options that work well for ordinary people like you and me. Today, I'll break it all down to bite-sized pieces. By the end of this video, you will feel confident enough to take that first step towards building your wealth. Let's start with index funds. Think of an index fund as a basket of stocks that mirror a specific part of stock market. For example, the S&P 500 is like a VIP list of 500 of the biggest, most profitable US companies. Apple, Google, Amazon, you name it. When you invest in an S&P 500 fund, you are buying a tiny slice of all those companies at once. Why is this genius for beginners? Number one, diversification. If one company has a bad year, others might do well, balancing things out. It's like not putting all your eggs in one basket. Number two, low cost. Index funds are passively managed. No expensive fund manager picking stocks. That means super low fees, often just 0.1% per year versus 1% for active funds. Number three, long-term growth. Historically, the S&P 500 has grown about 7 to 10% annually after inflation. That's your money doubling every 7 to 10 years. But wait, there is a catch. Index funds go up and down with the market. If the whole market crashes, your fund will too. But over 10 plus year, market always recover, so patience is the key here. Next up is ETFs, or exchange traded funds. ETFs are like index funds' cooler cousins. They also track a group of stocks or assets, but here is the kicker: you can buy and sell ETFs instantly during market hours, just like a stock. Let's break it down. Flexibility. Say you are passionate about AI or solar energy, there is probably an ETF for that. For example, Global X Robotics and AI ETFs lets you invest in 30 plus robotics companies worldwide. Affordability. Many ETFs lets you start with just $50 to $100, plus their fees are even lower than most index funds. Number three, transparency. ETFs show you exactly what's inside them daily, so no surprises. But remember, because ETFs trade like stock, it's tempting to check them every hour. Resist that urge. ETFs are best held for years, not days. Treat them like a slow-cooked meal, not a fast food. Now let's talk about the blue chip stocks, the celebrity A-listers of the stock market. These are massive household name companies like Coca-Cola, Johnson & Johnson, Microsoft. They have been around for decades, survived recessions, and paid dividends like clockwork. Why beginners love them? Stability. Blue chips don't swing wildly like small startups. If the market drops by 20%, they might drop 10%. Dividend. Many pay you just for owning them. Coca-Cola, for example, has paid dividend for over 60 years. Reinvest those dividends and you will earn compound interest. Money making money on itself. Easy to research. You already use their products. If you trust a company's brand, that's a good sign. But a word of caution: even blue chips aren't risk-free. Remember Nokia and Blockbusters? Always diversify. Don't put all your money in one stock, no matter how safe it seems. Ever wanted to be a landlord without fixing leaky faucets at 2 a.m.? Meet REITs, Real Estate Investment Trusts. REITs are companies that own income generating real estates, apartments, malls, hospitals, even cell towers. Here is the magic: passive income. By law, REITs must pay 90% of their profit as dividend. That means steady cash flow. Diversification: you are not just buying one property, you are investing in hundreds. Accessibility: a single REIT share can cost as little as $20. No need for a mortgage. For example, Realty Income ticker O is a REIT that owns 11,000 plus properties. They pay dividends monthly, perfect for bills or reinvesting. But beware, REITs can be sensitive to interest rates. If interest rate rises, their borrowing costs go up, which might lower dividends. Balance them out with other options. Last but not least, government bonds. Think of a bond as a loan to the government. You give them 1,000 today and they promise to pay you back with interest in 10 years' time. Why they are safety net? Guaranteed return. US Treasury bonds are backed by the full faith and credit of the government. They have never defaulted. Steady income. Bonds pay interest twice a year. A 10-year Treasury bond might give you a 4 to 5% annually, less than stock, but predictable. Portfolio cushion. When stocks crash, bonds often rise. They are like shock absorbers for your investments. The downside is bonds won't make you rich. Inflation can eat into returns over time. Use them to balance riskier investments, not as your only option. And there you have it. 5 easy investment options that are secure, profitable, and perfect for beginners. Whether you choose index fund, ETFs, blue chip stocks, REITs, or government bonds, the key is to start small, stay consistent, and think long term. If you found this video helpful, smash that like button and subscribe. It helps the channel grow. Let me know in the comment section which investment are you most excited to try. Thank you for watching, and remember, the best time to start investing was yesterday. The second best time is today. See you next time.